Love the music. Hello and welcome to the first quarter market update from Uber Freight. I'm here today with Mazen Danoff, our applied scientist. I call him our chief economic officer at times. And then Nathan Adams, vice president of procurement, and myself, Russell Zuppo, leading consulting services. Our agenda today is that Mazen's going to start with our economic update and talk us into the outlook. I will take over next and talk a little about what we're seeing in our 4PL data and some of the consulting trends. And then lastly, Nathan will take the mic and talk a little about procurement and best practices and what we see going forward in procurement. And we'll follow that up with some Q&A. So with that, I'll hand it off to Mazen to get started.
Thank you, Russell, and good afternoon, everyone, or good morning. So I'll start with the regular economic outlook covering truckload supply and demand and where we see rates and volumes heading next. But at first, we can't start without talking about the main topic of this week, which is tariffs. So we have received a lot of questions about tariffs, a lot of concerns about customers asking what should we do, or what some customers like telling us what they want to do. But in general, we have a few key points on this slide saying that tariffs are on hold for now. They were postponed by 1 month, which should allow some time for negotiations. So hopefully this time will allow, these negotiations will allow averting these tariffs to avoid the damaging consequences, which could affect all 3 countries. So they could severely affect specifically Canada and Mexico, and to some degree also the United States. So the severity of these tariffs or the severity of these consequences makes the implementation less likely and an agreement more likely at this point. If we talk about the US, tariffs could push inflation higher. Some studies the last week estimated the impact at about $1,000 to $1,200 per person in extra expenses, which could increase inflation. It could delay further rate cuts, and it could negatively affect the trajectory of where the economy has been heading recently. In the long run, there could be some positive impacts of tariffs, especially in boosting the manufacturing sector and favoring the domestic manufacturing over imported goods. But in this case, since tariffs are proposed to be implemented in such a severe and quick way, it's more likely that if we see them, the immediate damage will be more significant than the long-term benefits. So it's less likely that we see these long-term benefits. Of course, if these tariffs are implemented, we could see a significant impact on cross-border volumes, resulting in abundant capacity. Intra-Canada and intra-Mexico volumes are specifically more vulnerable because these 2 countries have approximately 75% to 80% of their exports going to the US, and exports make nearly 1/3 of each of their GDPs. So their effects will be severe on these 2 countries. So because of all of these negative consequences, it is likely that a month is given so that an agreement can be reached to avert these effects. So if you ask me about the base case, most likely an agreement will be reached. During this month, we expect to see some cross-border activity, especially into the US, as shippers prepare to have some safety stock in the US in case an agreement is not reached by the end of the month. So I don't see this happening long-term for like tariffs staying there for months and months, but in case an agreement is not reached in time, shippers are preparing for safety stock. So now that we spoke about tariffs, let's speak about what's happening with the rest of the freight market. We've seen a very busy peak season in 2024. Rates surged in December. They continued to be tight in January, and now we're seeing rates falling. So there's a lot of charts here showing spot and contract rates for truckload modes in the top charts, and the bottom charts show prices for intermodal, LTL, and parcels. So focusing on the top, this goes until January or until December or January. So it does not show the drop that we have seen recently in spot rates. But we have seen a surge in spot rates, as I said, in December, where spot rates remained positive year over year, about 5% higher than the levels that we saw last year. We have also seen an increase in contract rates, which have been flat for almost a year before that decrease. We've finally started to see them increase again. And this was observed, like these trends were observed across all three trucking modes, van, reefer, and flatbed. Now, in the second half of January and until February, rates started falling off a cliff, which is mirroring what we saw last year. So last year, if you remember, we had a similar winter freeze affecting huge parts of the US, and then rates fell off a cliff. And this year, we're seeing the same trend happen again. A huge part of this is seasonality. Whether rates continue to fall and reach negative year-over-year levels, this will be like a bearish sign for the freight market, indicating that the market is still soft, is still softer than what we had expected, and the tightness was mostly seasonal and driven by weather events. So as for other modes, intermodal prices have been stable. They tend to follow truckload contract rates by a quarter or so. So since truckload contract rates just started increasing, we expect a similar trend to happen with intermodal prices, but not a significant increase. LTL prices have been increasing slightly at a healthy rate, but less than the historical growth rate of about 5 to 7%. We're seeing a slower growth rate. Part of the reason is because we've seen the Yellow bankruptcy, which took a significant amount of capacity of the market. But at the same time, demand in the LTL sector remains weak. And in the parcel sector, we continue to see the year-over-year increases. We haven't seen a sign of a freight recession as we saw in other sectors. So we continue to see approximately 5% year-over-year growth consistently in this sector. So that's about rates. Now I'll move to demand. When we talk about truckload demand, we focus on three areas: retail or consumer spending, wholesale, and manufacturing. Consumers continue to drive most of the growth in the freight market. If you look at the first chart, which is real spending on goods adjusted for truck tonnage, this shows that spending on goods, even when you adjust for inflation and tonnage, it's at an all-time high. Consumers are still spending more than ever. If we look at the latest GDP report or the latest personal consumption expenditures report, it shows a healthy level of spending, especially on durable goods. So the US consumers are still in a healthy shape. If you look at the other two sectors, wholesaler sales and manufacturing output, that's where we see demand struggling. So these two sectors have been mostly flat year over year to slightly down. They continue to be 4 or 5% below the all-time highs that we saw in early 2022, and we haven't seen any signs of significant recovery yet. So going into the manufacturing sector, there are some early signs of at least hitting the bottom or some signs of early improvement coming from this week's ISM PMI or Purchasing Managers Index report, which is an index that measures the overall health of the manufacturing economy. This index increased to 50.9 in December. In January. There's a typo here. So it increased to 50.9 in January. This was the first expansion in 26 months. So the first expansion after 26 months of contraction. As a reminder, this index has a cutoff of 50, which is the expansion threshold. So anything above 50 indicates growth. Anything below 50 indicates contraction. And when you look at this chart, we are seeing a trend of moving from contraction to expansion, whether we look at the PMI or the sub-indices, which are production, new orders, etc. So the latest report points to increasing new orders, increasing levels of production, prices increasing at a slight rate, not severe inflation, but prices are back from disinflation, and employment has stabilized after months of layoffs in the manufacturing sector. Another positive sign we're seeing on the freight demand side is a high level of imports. 2024 ended with a strong level of imports that exceeded 2.4 million TEUs for most of the year, most 2.4 million per month. Average over the entire year, it was 28 million TEUs, a 13% increase from 2023. We also saw a 12% increase in December year over year and a 24% increase compared to December of 2019. So imports are back to the historical levels that we saw in 2020 and 2021, reflecting continued consumer strength, but also shippers that are pulling forward their imports because they were expecting tariffs. So now moving to the supply side, I'd like to focus on a key indicator, which is trailer sales and production. So these charts here show production orders and build, production orders and sales of dry van trailers for the 3 years, 2022, 2023, and 2024. The way ACT Research described this is that the worst might be behind us, according to many OEMs. Tractor and trailer orders, although they ended 2024 significantly lower than the levels that we saw in 2023 and 2022, December and November especially saw high levels of orders. And these high levels of orders, which were flat to slightly, in some cases, slightly positive year over year, whether we look at truck or trailer orders, to me, they reflect carrier confidence that the market is starting to show signs of recovery or signs of stabilization. So carriers are less likely to order trailers and tractors when the market is soft, when their expectations are bearish, and when they are optimistic about the market, they order more tractors and trailers. So given that the worst is behind us, it might signal some level of confidence among carriers that the market might be heading towards some recovery or some stability. That being said, carriers' operating costs remain well above spot rates. They are on par with contract rates, as this chart shows. So operating costs are shown in red, contract rates are shown in blue, and spot rates are shown in black. We can see that carriers are barely making margins on contracted freight. Spot rates are much lower than the carrier's operating costs per loaded mile, which means that more capacity will continue to exit the market because it's not profitable for most carriers, especially small ones that thrive on the spot market. So more carriers will continue to exit the market until supply and demand come to balance. So it's more likely that spot rates will increase to catch up with costs than the other way around, because it's hard for costs to come down further at this point. It's an unlikely scenario. So now that we covered supply and demand, I'll go over the short-term and long-term outlook. So for the short-term outlook, this chart shows just seasonal pressures in February and in April, 3 months from now. February is usually a weak month where we see some softness across most of the US, except some of the northern parts, which are tight because of weather disruptions in the Northeast, in the Midwest, some of the mountainous areas. But key markets like California, Florida, Texas are still cooling off from peak season. The chart to the right shows April, which is a much softer month. So usually rates continue to drop between February and April. And this is expected to happen across more geographies. We expect to see some tightening starting to appear in southern Florida, southern Texas, driven by some early signs of produce season, but that's all. And now moving to the long-term outlook. So for freight demand, as I said, the base case continues to see no tariffs implemented. It's likely that they will be negotiated. No external shocks on the horizon, like lockdowns or stimulus or anything that moved the market in the previous cycles. We don't see that on the horizon. However, we see a gradual recovery in manufacturing and housing if the economy continues to move the way it has been moving with less inflation, more rate cuts, and a healthy consumer. On the supply side, as I said, there's more confidence among carriers, among OEMs. Truck operating costs are high, which means capacity will continue to exit the market. And trucking employment has stabilized after months of declines, but the smaller carriers continue to exit the market. So if we look at FMCSA data, we continue to see more revocations than new authorities. So what does it mean for rates? As I said, spot rates were positive year over year. We expect them to continue to be positive throughout this year, but not by a significant margin. We're looking at various forecasts, and there is a range of variability of these forecasts. The lowest expects a 5% increase. The highest expects a 20% increase. We are more leaning towards the lower side. It seems more likely at this point, especially given the recent softening that we saw. Seasonality continues to be the primary mover of the market. So like last year, we saw periods of tightness and periods of softness coinciding with peak season, with produce season. So seasonality continues to be the main driver. And contract rates, which started to increase, are likely to increase further, but at a slow rate, especially if spot rates do not increase as much. And with that, I'll hand it to Russell to go over our latest Uber Freight trends.
Thank you, Mazen. So this data I'm going to share here is from our managed transportation service that covers around $18 billion in freight spend. So it's a pretty good estimate of what we're seeing in the market in general. What we like to look at first is really tender acceptance. So you can see at the chart on the left, the first tender acceptance has kind of been dropping, very gradually year over year. But you can see at the end of the fourth quarter, we were down under 90%, which is the first time we've been at that level since 2022. And the same with route guide compliance, that's down as well. But a lot of that is, like Mazen said, seasonal. You can see end of every year it tends to dip, but a little bit lower this year. So the difference is the first tender acceptance is exactly what that is. It's the first tender that goes out to your carrier. And then the route guide compliance is typically if you have multiple carriers on a route guide, it'll go out to, if that first carrier rejects, it may go out to another carrier and another one after that potentially and down the line. And so it's, do you stay on your route guide for your contracted rates essentially? And so some shippers anticipate some slippage, so that is more important, and other shippers are more about that first tender. The last chart on the right here actually shows the inflation. So if it is rejected off a primary carrier, what is the inflation? And it's real hard to see on this chart. I apologize because it gets light gray on the very bottom right there. But you can see it's about 4.5% now. The inflation has kind of sharply went up just for that end of quarter. And what that's basically saying is if my primary rejected, I'm paying typically about 4.5% more than contract on my rate. So there was a little bit of, I'd say, an increase in spot and increase in coverage, but mostly due to seasonality in that case. A little sharper than last year. You can see last year's small peak was about half of that. So if we actually break it out on modes, you can see the same thing happened across all the modes. It was down. This is first tender acceptance. But I did cheat a little bit here, and I included some January data on this. And you can see there's a bounce back effect in January in most cases here, especially for van and reefer, but not quite up to that level. So that it was prior to December. So what you're probably really seeing here is a little bit of seasonality from the weather, a little bit of catch up, but it's also potentially the start of a continued trend and a market shift. And similar, service has continued to drop. So typically when you see tender acceptance down, rates up, you see service drop, and service didn't drop beneath last year's levels. It really met last year's end of year levels. So we'll see where that goes in over the next quarter. But kind of matches the expected seasonality here and the trends we've become accustomed to. So a little bit about the headlines and what we're seeing in the consulting space. So procurement bids, I would say, took a towards the end of the year and coming into January, we're kind of on par with what we normally see. And then they took we're getting a flurry of activity, let's say, on bid management coming in right now. So we're seeing a lot of folks that are kind of smelling a market shift that really want to get a bid on the street, and they weren't necessarily planning it coming into the new year. We continue to see a lot of interest in dedicated right sizing. A lot of that is tied to dedicated procurement. Shippers want to go out to bid with dedicated, and they want to make sure they're right sizing the fleet, not necessarily relying on the carriers to tell them what fleet sizing is. That's been a trend probably for about a year, going on maybe a year and a half now, high level of that. In the warehouse space, construction is still at its lowest levels since 2008. And vacancy rates also continue to rise, right? So this is a little bit at odds with consumer demand, but matches well with manufacturing demand and wholesaler data that Mazen shared. And there's some markets out there now where there's oversupply and some really good opportunity, thinking places like Austin, Phoenix, Las Vegas. Those kind of locations have kind of overbuilt, and so space is probably easy to come by and at a lower cost than I would say you would pay a premium in other locations. And then network strategy and design. We've seen a lot of activity around longer range planning, looking at the 2030 and beyond time range, and what kind of the setup for those is based on anticipated growth. The other thing we see quite a bit of, and despite all the tariff talk and near and potential tariffs that we see, the nearshoring to Mexico is still a hot thing. We have seen some, I would say, delays in that space, meaning folks that were maybe planning to launch something put a little bit of a delay on it, but we're still seeing the same high level of interest in moving production to Mexico. So that's it for kind of what we're seeing in the consulting space. I will turn it over to Nathan Adams to talk a little more about procurement.
Yeah, thanks, Russell. It's always fun to listen to Mazen and Russell go ahead of me because we compare notes ahead of time, but in detail to be able to hear what they say, how it aligns to kind of all we're seeing across all pieces of the business is always kind of cool. But so just talking about procurement as a whole, I'll echo a bit on what Russell said around what he's seeing it from a consulting standpoint. He's seen kind of a flattish demand for procurement events. I'd say we're seeing the same thing on the transportation management side of the house. So my team does a lot of what we handle a lot of transportation management customers that we work with at Uber Freight, whereas as Russell may handle a lot of folks outside of that core team. So we're seeing it from all sides, whether it be a consultant engagement, whether we're seeing it from team customer. Bids are about flattish, right? So a lot of people bid last year, they're kind of bidding this year. I think in the past, whenever things start to get tight, a lot of folks want to get creative and understand, should I do multiple bids a year? Should I break up my network? Kind of what should I do? I'll tell you, we haven't had a ton of those discussions yet, which is kind of telling us that there's still, it's tightening up a little bit based on what Mazen said and kind of what I'll show you here, but not to the point where there's a ton of pain or they can't find coverage or where they have to kind of think outside the box to do different things. So just back to overall like trends and what we're seeing, we're still seeing some save overall on the truckload side of the house. Now I'd say on the incumbent side, very much we're seeing the incumbents coming in trying to hold on price or gain some price. And I'd say the shippers are really working with their incumbent carriers to make that happen if they can. So they're willing to pay their incumbent carriers, obviously a little bit of a premium for their past service and relationships, and they're going and finding that save somewhere else in their business, whether it be transactional lanes or spot market or, like I said, less strategic customers or however they decide to cut it. Those incumbents, they're kind of keeping them secure, but then they're willing to go and change carriers outside of that. Sorry, from a carrier behavior standpoint, we're tied in pretty deep with the carrier base. I'd say they're also starting to see, some pricing hold. If you look at some of the earnings that have come out recently, some of the ORs are starting to improve slightly. Some folks are starting to see upticks in volume and win rates. Some have not, and so it's really is a mixed bag when you go out there and look at the carrier public earnings. But I'd say that they're starting to get price, especially the bigger carriers who have long-standing relationships. And so we had a carrier in today actually, and they weren't overly optimistic, but they were saying, hey, we're starting to make a little traction. So that's kind of the feel I think we're all saying at this point, is that it's like you start to see a little bit of a turn, especially on the contract side, but we're all anxiously waiting to kind of see what holds. And lastly, I hit on that carrier pricing piece around, we're still seeing some little bit of save. There's still save opportunities in networks, and folks are still trying to get them, but again, really trying to honor their incumbency. So this slide, we intentionally keep the numbers off this on the axis just because it's our save percentage, and lots of baselines mean different saves that don't quite line up, but we try to give a directional input. So if you see the blue line on the bottom, that's really where our finalized savings is coming from, right? So you can see that drop, right? Since we've all been, doing this since, 2020 or 2022, kind of when we're at that peak and where there's a lot of dollars to go get, to where the market has really started to adjust, and there's just not as much save on the table. And it makes sense when you start seeing year over year over year, how much is there to get? And obviously there's less and less out of it, especially out of these folks, incumbents that they've been doing a lot of business with. Now that black line on top, that is where, that is the going in save rate we see just in like that base scenario. So no constraints, no service, anything in there. It's just, give me your price, give me your capacity, and let the model run. And that's what we see. So what's interesting here is you see that uptick, right? So they pretty well follow each other most of the time. And I'm assuming that's going to kind of right size itself, but we have seen an uptick to where, a lot of carriers are coming in and still trying to throw some really low pricing in, right? And, Mazen touched on this earlier about, carriers that are revocations, going out of business, and that you're starting to see some of that capacity leave the marketplace. A lot of our theories is we're seeing a lot of the brokers who smaller brokers who are getting ready to exit the industry are trying to just throw rates and see where they stick, to see if they can get any kind of cash flow. And so that's where we're seeing a lot of that uptick. It gets quickly right sized in that scenario management, and kind of gets you down to that normality that is shown there on the screen. So again, you're seeing a lot of folks jump in, trying to see what they can get, but our customer base and the shippers are really right sizing that and being mindful of not chasing those, real shiny rates, right? They're being more mindful of what they are going after, how much save it is it a realistic save, and not just, looking at a paper rate and going, man, that looks good, let's try to put it in the network. Okay, just, best practices for 25. A lot of these, we've been talking about for a while, and they definitely still hold true. And you think of the market we've been through the past few years, as it starts to turn, here's where a lot of the work, we've been doing with our carrier base and building relationships kind of really start to take hold. And you can see it in some of the pricing, as I mentioned, with the incumbent folks. But really, it is get your partners close to you. They've been going through this market as well. Really establish those key relationships with your key carriers. Build out the long-time goals. Develop formal review processes, and really work with them on how do I improve them as a partner, not just a transactional carrier, right? So you're going to want to bring your big carriers, your big providers, not necessarily in size, but in meaningfulness to your organization, closer to you as much as possible, and really build up those relationships. Because it as you can see, it's been very, very volatile. Spots going opposite a little bit of contract, right? So they're trying to establish where they're going to be in the marketplace, and it's just good to have you really tied in with your key carriers and the relationship standpoint. I'd say there's probably going to be a lot of volatility coming up still. We're still not sure what the market's going to do. We feel like it's going to continue to increase, continue to make gains on the contract side, but there's a lot of pressures that we covered earlier in here that may or may not materialize that could impact that. So best line of sight we can see is that you're going to continue to get that increase in contract price kind of throughout the year. and with that, there's a lot of things you have to do from a shipper standpoint to help try to mitigate as much as you can. And really, it is what carriers may make sense to get into the business that may not have been there before. Obviously, you don't want to go and take a broker, put anything at risk, or someone who you think may be ready to go out of business, as we just talked about. And really bring those carriers close to you, understand the rates, like get details with them, have those real detailed negotiation rate discussions. It's always good to kind of dive into the weeds with them and not leave it at the macro level. It just really tries to provide that, cost and transparency, working with your companies and the carrier base. Understand the carrier technology still. We're seeing a lot of strides in not only API, but a lot of other, technologies from a track and trace standpoint. And so it's good to be able to understand those technologies that the carriers are developing, continue to leverage them in their business, challenge your key incumbents and your key partners of what are they building into their, in their world for their customer base. That's going to be an immediate benefit to you. It's really going to help drive that partnership and bring it closer. And then, last thing I'll hit on is just your routing guide, critically important. There's probably 1,000 ways to set those things up and, every different company, but it's kind of like formulate your routing guide strategy. Where do you insert your key players? Who's going to be primary? How deep do you go? Do you have a catch-all? Do you have someone looking after your spot? All those are discussions you should be having from a procurement standpoint and how to set up that routing standpoint. And so I will pause there and we'll transition to the Q&A session, which I will lead us through. So first one, the easy one, will the presentation be sent out? Yes, absolutely. We'll make sure to get everyone a copy after the webinar. So that will be on the way. I will take, there's one here, I'll read it out loud and I'll take it, and then I may ask Mazen to kind of jump into. So the question is, if carriers are exiting the market, this means there are a lot of equipment for sale. Why do we think other carriers will order other equipment, especially if they aren't making profits? So yeah, there's a lot to that. A lot of the exits in the industry right now, you kind of see some broker entries that have come in the past few years, and now they're exiting, right? So they've just been fighting for the same capacity with the rest of us. So they wouldn't actually have any equipment once they go out. I'd say that a lot of the I'll let Mazen maybe talk about the used trailer market, but a lot of the big folks are really trying to refresh their equipment, which drives a lot of the trailing production. When the big guys are putting a lot of orders, it's driving a lot of equipment, and so they're obviously trying to refresh fleets, get more capacity, and build that out. So that's why you probably aren't seeing a lot of those used equipment types flowing back into the larger carriers. They're going and buying new, making new, and they're also cycling out their old, which a lot of those trailers will get kind of sold off on the secondary market. So Mazen, I don't know if you had anything to add there to clarify.
Yeah, thanks, Nathan. So yeah, it's two different populations of carriers. So the larger carriers are mostly ordering new equipment, new trucks, new trailers, while the smaller carriers are using second-hand equipment. So the reason we saw an increase, and one of the reasons we saw an increase in tractor and trailer orders, as Nathan said, is because they're trying to renew their used fleets. And over the last 3 years, we saw some reduction in overall freight volumes, but more importantly, we saw a big shift in general, from the spot market to the contract market, as spot volumes almost dried out. From non-asset-based carriers to asset-based carriers, especially consolidating among a few. So this all favored large carriers. So in general, if you look at the volumes that these carriers saw, they didn't decrease that much, or like in some cases they increased. They were not very profitable volumes, or not very. They didn't have high margins, but the volumes themselves were healthy. So these carriers have been using their tractors and trailers and need to replenish them. But of course, every time they order a truck, they dispose of an old one into the spot market, or most of the time, which has been increasing supply in the second-hand market, and this has pushed the prices of used trucks lower. And this is one of the reasons that allowed capacity to remain in the market this long in such a soft market. So one of the reasons is that the prices of used tractors have been so cheap that carriers were able to afford them and not pay excessive amounts, given that they were barely making any profits in the spot market.
Awesome. Yeah. Thanks, Malden. Appreciate that. Okay. So just a question on data clarification. So I'll probably tag Russell into this one. So service and routing guide data, kind of what's the data source, and is it the whole market? Is it Uber data? And kind of what's that data makeup?
Yeah, so the data I went through is just Uber Freight 4PL data. So it's the 18 billion that we manage on behalf of let's say about 180 to 200 shippers. It's a pretty good cross section of the market. It's got a lot of industrial, it's got a lot of chemical, it's got a lot of kind of consumer packaged goods, and some retail in it too. So it's a pretty good set of data, and we feel it's a pretty decent representation of the market.
Cool. Thank you, sir. So there was another question on tariffs. So what about the tariffs? Will this increase freight costs in the U.S.? Exports, imports, all the above. There's a slide that Mazen covered at the beginning of the deck, which does a really nice job of trying to line out like our thoughts on it and kind of what we're seeing. But overall, they're on pause, and we are assuming that they're going to get negotiated, and hopefully that will be the case, right? Now, if they do go into place, there's definitely going to be some pressures in the industry, right? I think Mazen hit on, when there was the fear of them going into place, folks started pre-deploying inventory or started slowing down their imports or sourced differently, right? And then that quickly stopped as the tariffs did. So I would expect a lot of those conversations to pick back up, but also on that one, Mazen has a really good slide at the beginning of this that covers down all that. And then if you have any questions, of course, just reach back out to Uber. Okay, going down the Q&A here. So there's one, how can a company compare their rates to the market in a specific industry? Russell, I'm probably going to tag you for that one, but I'd say there is quite a few options there, right? And I would say we have a really good consulting team who can definitely help and direct there.
Yeah, we don't do a ton of benchmarking, but we could give you a sense through kind of maybe an index or something of a specific industry on what your rates look like compared to the market. Once you start to narrow down the data, meaning market specific, you get less accuracy on the rates because you have less density. But depending on the market, there's ways to do so.
Mm-hmm. Got it. Thank you, sir. Going through our Q&A here. Okay, so I can take this one. Do you have any insight to how the recent LTL carrier acquisitions, divestitures will impact the market? For example, FedEx, Knight, Swift consolidation, that type of thing. Yeah. So in the LTL world, even with the divestitures, we haven't seen a ton of difference in capacity, right? I mean, the big shock to the system was the yellow exit, which caused a lot of havoc and then quickly right-sized. So the LTL market, I'd say it's pretty stable from a ownership's changing, things getting spin out, but the overall capacity really hasn't been impacted yet, other than the big yellow exit. From a truckload consolidation standpoint, I'd say the Knight and Swift is a great example. We're seeing a lot of when folks do acquire other carriers, they're really trying to acquire the capacity, and so we don't see often where the large carriers will acquire another carrier and then go cut trucks out, right? We see a lot of where I know, I won't speak for the Knight and Swift folks. We're great partners with them, but a lot of folks they still are running that semi-independently, starting to merge where it makes sense, and a lot of other folks are. So my thought to that is it shouldn't have a big impact on the overall market. It should make the carriers that are buying up the other carriers have more obviously buying power and reach. But as of right now, I'd say those aren't impacting the market in any major way. Sorry, I'm just reading some questions. Okay, another one for me. So from a procurement standpoint, what length of term makes sense for contracting rates with an extension of existing or new rates received in a bid? Is it 3 months, 6 months, year? And I'll tell you what we typically will tell our customer base for this question. We recommend a year term for your bid, but we also recommend is that we maintenance it probably on a monthly basis, right? So what we encourage our folks and our customers and our operations to do is we got to set our baseline, right? You set that baseline for the year, and then you start to measure against it. And what's my PTA? What is my service levels, and so on and so forth. And there's going to be fallout, right? There's going to be churn. There's going to be new lanes, and so a lot of that is what are some folks will want to go through and say, let's bid every 3 months, like let's capture everything that changes in my network. We still want to leave the baseline in place, so we really don't want a jump ball every 3 months or 6 months. We love to have that year-line baseline, and then we make changes throughout. So lanes may go away, lanes may be added, and so then how do we optimize that subset back into the broader network? That's a lot of what we do here. My team will help with from an Uber Freight standpoint on how do we procure, how do you make sure the networks are staying whole, how are you monitoring all the fallout? Because this, to this point, you don't want to set it and just like come back in a year and look at it. Like it would not be great, right? Just because there's so much volatility and so much churn in these bids now. It can't be the set it and forget it model that it was 15, 20 years ago. So hopefully that clarifies that question. We recommend the year, but we also recommend like very deep analysis of your network to fix those pain points on a monthly basis. And that'll just help get you into the next bid to where you also mentioned in this question potential pre-negotiation. Yeah, 100%. If you have incumbents that make sense to do that with, I would encourage you to do it if you can get market relevant pricing. It's always good to keep the network whole. Okay, still looking through here. So here's one. So what does a higher capacity as seen currently mean for brokerages? So is that resulting in higher tender acceptance, or are they unrelated? So I'll take a stab at it, and I'm happy to jump in anybody else here. So the high, when there's more capacity in the market, obviously it's easier for brokerages to get the capacity, right? And so what we're starting to see is a lot of these brokerages, the smaller ones who've entered the world here in the last couple of years, like it's getting harder and harder to find those trucks, right? And so as that continues to capacity exits, right? There's less trucks for brokers to get, and there's more competition to get those trucks. So that's really you start to see in tough times, brokers will be the first one that'll start to lower their tender acceptance, just because they aren't able to go and get those trucks, right? I don't think we've seen that quite fall off a cliff or anything yet, but we would expect obviously a tighter market is going to yield some lower tender acceptance, especially when it comes to the broker side. Okay, I think we may wrap it there because we are only a couple minutes away from ending this thing. Let me do one last check to see if there's anyways. No, I think we'll wrap it there. And so I really appreciate what everybody's doing. Obviously, very, very well attended today. So we appreciate everyone attending, and just thank you very much. We know you have a lot going on, and there's plenty to do during your lunch hour, and we appreciate you all taking some time to spend it with us. And hope to see you next quarter.